Good afternoon and welcome to CanadianAgMarkets.com. My name is Brian Como. We are recording this right at or just after 1 o'clock p.m. on Tuesday, the 20th of May, which means the markets are not quite closed yet, but we are going to take a look at where the markets were right at 1 o'clock. This is a screenshot of futures right at 1 o'clock p.m. today. Um, don't imagine them changing a whole lot into the close, but it's possible. And we got some big gains here today, and so it is possible we see a little bit of extra change from now till the close. So just wanted to disclose that as we move forward. But let's talk about what's happening in the marketplace today. Canola up $16.50 as of this time. It started off a little slow this morning, but gained some legs as the session went on. Currently trading at 719.20. Minneapolis wheat is up 11 and a quarter to 596 and three quarter. Kansas wheat is up 14 and a quarter to 537. Chicago wheat is up 16 and a half to 545 and a half. Soybeans are up 2 cents at 10.52 and three quarter. Corn is up 6 and a quarter to 4.53 and three quarter. The Canadian dollar is just shy of 72 cents, a little bit higher at 71.84 today. Live cattle up 0.225 to 213.20, and feeder cattle up down a little at 297.45. All right, I'm going to focus a little bit on wheat to start the day off today. This is a chart of Chicago wheat. As you could see, last week we kind of saw it climbing up from the lows that occurred on a May 13th, I think it was. And it's kind of been inching higher. We hadn't really gotten any kind of confirmation that it was going to break above or break the trend. But today we did see a little bit of that. We saw it kind of break the trend line, or the line between all the recent highs between April 14th, the end of April, etc. We've also seen it break above the 20-day moving average, which is a good sign for Chicago wheat. There's a couple of things that are happening in the marketplace, but I just wanted to kind of point out one thing. This is, let me see here. Here's the Chicago. I mixed up my charts here. So we got, this is Chicago, a little bit longer term chart. But what I wanted to show here was the commitment of traders, the disaggregated managed money portion of the commitment of traders. So this is funds, speculators, et cetera. They are, as of Tuesday of last week, there were 121,541 contracts short. So this was a relatively large short position, not a record short position by any means, but still relatively large. The funds had pushed it down through the month of May to these lows. So any kind of potential supply shocks do tend to get a little bit more attention in the marketplace. And I think that's part of the reason why we're seeing such good gains in Chicago today, is just because of the size of the short position. So we may have some stops getting triggered. We may have some profits being taken, those types of things when the market gets to kind of more extreme short positions. Now I'm going to attempt to back up here to the Kansas chart. Let's see. Here we go. Here's our Kansas chart today. We, again, similar kind of pattern, right? We are moving a little bit above the 20-day moving average here. I suppose if you kind of connect this high and these highs, we haven't broken the trend line yet on Kansas, but we would have broken a more shorter term trend line when connecting these April highs to the late April or early May highs. We would have broken that trend. So there is some kind of trend reversal action happening on the charts here in Kansas as well. And I did want to kind of point out here in the managed money disaggregated commitment of traders report, we are at 77,000 or a little less than 77,400 contracts. So this is, again, not a record, I don't think, of a record short position on Kansas wheat, but it is a very large short position on Kansas wheat. And as a result, we kind of see some uptick in markets when traders get spooked, when they want to take profits, when they want to limit losses and that sort of thing. So today's gains are likely a courtesy of some of those factors. Just to show the Minneapolis wheat chart again, it's kind of been lagging a little bit, as we've been talking about, as the protein spreads have kind of been shrinking here. There's no shortage perception of shortage of hard red winter wheat, which creates kind of an environment where protein isn't valued as high, and as a result, Minneapolis wheat tends to fade against the Kansas. That has been happening in recent weeks. Today, we still do see some positive trade on the Minneapolis, though, up above that 20-day moving average. That's about the only technical positive here. I guess you could say it traded back above these series of lows here, which we thought was going to be support, but ended up not being. But so far now we're back up to trading above those lows, sorry, and tickling the 20-day moving average today. So we'll see where that ends up. But overall, I think Minneapolis will go in the same direction as the winter wheat classes, just maybe not as aggressively at this time, at least. Anyway, we also are seeing some carry through in the wheat markets in the Euronext milling wheat contract, Matif milling wheat. Again, solidly trading above the 20-day moving average. A good day's gain today as we started the day off just about 203 euro per ton, now up to 209 or so. So all, kind of across the board, we are seeing gains in the wheat complex. So let's dive into it a little bit here. Here's winter wheat crop condition ratings. We did see it drop um, week over week from 54% good to excellent to 52 percent good to excellent. As you can see on this chart, 52% at this time of year is still really good, a really good average. Almost yesterday or last week's crop condition ratings took us above the 5-year kind of min max. It kind of brings us now down to the highs of the last 5 years as well, above average, above the 2024 crop year. So still a good crop overall, but a little bit of a surprise to traders today that we did see a 2-point reduction overall in the US. So where's that coming from? We did see some of the states neighboring Kansas, I like to call it. This is kind of hard red winter country in here. Kansas, of course, being the largest one at 24% or so of the whole crop. But Colorado produces quite a bit of hard red winter. Northern Texas produces quite a bit of hard red winter as well. And so does Nebraska. And it's not necessarily as prominent because of the size of the other two declines. But, we saw a couple of points decline here in Nebraska as well. So overall, the winter wheat crop declined week over week, with some hard red winter areas being of the largest declines. Now we're getting really close, if not, we didn't see a harvest update on winter wheat in this last USDA report, but I think it might come next week. I'm thinking Texas has got quite a bit of their crop off. That might be one of the reasons why we're starting to see such big declines in Texas, as we do tend to see the ratings, kind of fall as the crop dries down and gets ready for harvesting. Another big headline today, we are looking at some inclement weather, or some dry, hot weather running into harvest, or running ahead of harvest here in Russia's largest grain region. It has introduced a state of emergency now as a result of the dryness and drought, and the same area last year did fall by 22% as a result of bad weather. So this, lack of rain in the next few weeks, or the rest of the month into June, I think is they're expecting it to be very hot and very dry. Now, when we kind of map that out here, these maps are a little bit hard to read. This is a map of all of Europe, but just kind of here's over here on the map. Let's see if I can draw. This is that southern part of Russia that is dry. This over here is Georgia, this area here. So as you can see, there's lots of dryness here, even in through Ukraine, in the southern areas of Ukraine, even these northern wheat areas of Russia over here are pretty dry. This is a precipitation anomaly, so some of it is called an inch or more lower than normal in an already dry area, and that takes us out to the end of May here. This is a 10-day forecast from today into the 30th of May. So just to give you an idea as to where that dryness is expected to come in. All right, for those of you who are not subscribed to our insights yet, it's only 99 bucks a month. We go far more in deep, particularly on fundamental analysis. We talk about strategies, we talk about some timing, we talk about risk management. We talk about all those things in our reports that we send out weekly, plus our hot takes, which are ad hoc as things in the marketplace exist. You get our morning commentaries as well, which are a little bit more in depth. As well, and give some more insights every day. And we wrap it all up with a nice bow at the end of the week. So, less than 1,200 bucks a year. You can cancel anytime. Please subscribe to our insights because we'd like to share more with you. All right, let's get into the oilseed side. Canola today did see some gains. As I mentioned earlier, it did kind of get off to a slow start. The front month was trading a little higher. July was trading a little higher to start the day off, but the November and the back months were in the red as we kind of started this trading day off. That has changed a little bit. We've now seen, double-digit gains in the July. It's back up to 718. As you can see, do I still have my nice writing tool here? As you can see, there's kind of this pattern here where we see 2 days of losses and then it kind of resumes the rally. And, this last one seems to be no different. So we've seen this 4 times in a row now. Now, I don't know if that means we're going to see a new high. As you can it kind of feels like the momentum is shifting more towards neutrality. Not saying that this bullish move is completely over, but it's not as hot, I don't think, as it once was, or some of the people who were short may have covered a little bit. It's getting a little bit more volatile, though. The last week's EPA announcement created some volatility, but it still resulted in only 2 days of negative trade. We're seeing that come back up now. Will we see a new high? It's possible. Last week I surmised that if this market was going to correct, that the strength in canola would need to come from the basis market. I still believe that there is some strength to come in the basis market, or the cash market, as you want to call it. But it looks like today we are still pricing in some fundamentals, some Canadian short fundamentals on the futures side. So, maybe it's a bit of a mix of both at this point. So anyway, positive day for canola. That kind of transfers into November as well. As you can see here, we still are well inside of the path upward here. Last week's EPA news didn't even break the 20-day moving average or the trend line that we've been tracking, since the beginning of April. So still a pretty steady progression upwards here in the November. So overall, good day for canola still. We are seeing the July NOV spread kind of widen out a bit again. That does signal that there is a little bit more of an acute demand in the July than in the November. We haven't reached those new highs. That did start fading in the last few weeks, though. So it was kind of we're kind of wondering if maybe the July had kind of finished its rally. So we'll have to see. We'll wait to see how this plays out here. But it's a positive for, widening spreads is a positive for price action in general. Crush margins, however, have been fading, which is not a positive. We're down to 91 on the board crush for the front, for the front position here now. That doesn't necessarily tell the whole story, of course. The front position is not necessarily where they're trying to fill. If they were trying to fill the front position, it would be that would be a significantly more acute shortage. We are seeing crush margins a little bit better as we move the calendar out. Still not stellar, but we did see the rally today in canola prices, and has not translated into high margins. As you can see, we are in the lower part of the margin over the last year or so. So that doesn't necessarily bode well for new business. Now, that might be price action kicked down the road a little bit because that's all kind of forward business booked, but just something to be aware of. Anyway, one of the reasons that crush margin is not doing well is because we haven't seen the rebound in soybean oil that we did in canola. So again, today's rally in canola is not necessarily being driven by the vegetable oil complex because that hasn't really rallied after the weakness that we saw as a result of the EPA news last week. So canola's rally today is, born more probably of tight fundamentals in Canada than it is on the soybean oil, which can be a positive for Western Canadian farmers. So we'll keep that in mind, and we'll keep updating you on that. Euronext rapeseed again is kind of pushing back to recent highs, or at least highs that we saw, into the beginning of May. Not necessarily the highs that we saw earlier in the year, but it is kind of, trading in a very wide range, trading near the top of that range, which might be helping out canola as well today. All right, moving on to corn. Don't have a lot to say here about corn. It is in a similar boat to some of the wheat complexes, though, as recently traders pushed this into a short position, and we may be seeing some of that come out of the market now. We might be seeing some profit taking. We might be seeing um, some stops get triggered, things like that. So we're seeing some positivity in the July in the corn market today after some significant weakness through the month of April and the beginning part of May. All right, for those of you who are paying attention, I replaced my art with Oilers jersey because I am now on the official Oilers bandwagon for the playoffs. They are now the only Canadian team left, as our Winnipeg Jets here, and even our partner Canes Toronto Maple Leafs both suffered some losses, some sad losses this last weekend. But now we're on the train. Go Oilers, go! In McDavid, we trust. Thank you for tuning in. We'll see you again tomorrow.